Hey everyone, Steve Fernandez here, research analyst with Winning Investor Daily and also our flagship newsletter, Strategic Fortunes. Today I want to talk to you about market seasonality, more or less the fluctuations in the stock market based on the time of year that we're in. It's a big psychological element of the market and it's been that way for a while. So I want to cover one question first from last week's webinar. But before we get started, if you like our content, definitely like our videos. And if you haven't subscribed, subscribe to our channel. Helps us grow and reach a bigger audience, which is always our goal. So question from last week was a question about BAT, which was the ETF that I recommended, versus LIT, which is another ETF dealing with lithium ion battery technologies. BAT, symbol BATT, is also a lithium ion battery ETF. Question was, why not LIT instead of BAT? So I'm familiar with LIT, and in fact, it did outperform over the last year substantially. But BAT, in my opinion, is a better play moving forward because it has less of its fund in China stocks. BAT has about 30% of its holdings in China stock or China equity, and LIT has about 45. So almost half of LIT is in China equity. To me, that's really risky. I think that, and a lot of people would agree, that the regulatory climate in China right now is very uncertain. It's kind of a dangerous place to invest. But with that being said, I think that there's also a ton of upside in China. So for me, I like to think of this as a steady grinder higher, and I think BAT gives you that opportunity. Now, moving on to this week's content. I'm sure a lot of you have heard of the Santa Claus rally or the January effect, more or less when stocks rally into the year end and into the new year. No one really knows for certain why that is. We can speculate, maybe New Year's resolutions or people are just more engaged. They're off of summer vacation. No one knows for sure, but it's definitely something that exists. You can see in this chart that the average monthly gain since 1980 has been really the highest around the end of the year, November, December, and the beginning of the new year, January, February, and even till the end of the first quarter. And in terms of percent of the time that it's positive, you can see that January, February, March, April, those are some of the best months in terms of ending on a positive return. Also, end of the year is strong as well. Now, we haven't seen that play out this year, and that kind of brings me to what I see as the best investment to capitalize on this and also in general for 2022 and beyond. Out of the three S&P 500, Russell 2000, and NASDAQ, I think that the Russell 2000 has the most to gain, and it will likely finish the highest in terms of a return next year. I said that these anomalies haven't really panned out as we expected. Now, the S&P 500 has had a strong month in December. It's actually up about 3% already, better than the longer term average. But the NASDAQ and the Russell are unchanged, and the Russell was even down 4% last month in November. To me, there's a big reason why that happened, and it's also an opportunity. When you think about the window dressing that portfolio managers do around the new year, they usually add the best performers to their portfolios so that they can tell their clients or prospective clients that we hold these stocks. In some cases, that might be to show that they knew about them or they were invested in them. It doesn't necessarily mean that they were invested in them before they did good. They just want people to think that they're holding them. And also around the new year, we see portfolio managers and even retail investors trim their losers to offset some of those winners that they're taking profits in. I definitely think we're seeing that now. We had a lot of people window dressing small caps into this year, because they were the top performers. And a lot of them got stuck in the trade. They're taking those losses now to prepare for the tax period that we're coming up on and into the new year. Now, with the Russell being weak, especially right now, and when you consider the underperformance this year, really just the sideways trading all year, the Russell is the best play right now. If you look at this chart here, you can see that since 2019, everything's up pretty substantially, but the Russell 2000 has lagged. Part of that, like I said, is what I just described, but a lot of it's because we saw a flight to quality here because there's so much uncertainty, and quality is generally seen as big cap tech now. So that's what we've seen. If you look in this other chart, this is a longer term time frame. You can see that over the last 10 years or so, on a log scale, the index looks pretty good. It looks like we're on track on an uptrend, and it looks like that weakness that we had in the last year or so has really just been the index obeying this longer term trend line here. I'm not a big technical analyst, but I think it's important just to look at the general direction and sometimes look at price and volume, for example. But when you extend this out about a year or so, you can see that, if this dances around that line and continues to do so, we could be looking at about 2,500 by the end of next year, which is a little bit under 20% return. That's a really good year. If you consider that the average market return is about 9, 10%, 11% in recent memory, and what I mean by that is probably the last 30 years, that's actually probably the best place to be right now. We've had 2 big years for NASDAQ, and that's captured in the S&P 500 as well. The biggest companies in the NASDAQ are also the biggest in the S&P 500. So I'm expecting to get those excess returns. Portfolio managers will put money into small caps. And because everything started late this year, I said that we haven't seen that seasonality captured into the end of the year like I expected. I think that we're going to see that shift up, or shift back, that is, a couple of months. So I'm expecting a big first half of the year, and I think small caps are the place to be there. You can buy into the index with the ETF IWM if you want, but I have a couple of ETFs, 3 for that matter, in the last video. If you haven't seen it, I suggest checking that one out to see what you can invest in for what I believe are the biggest trends moving forward. And that's going to do it for today. If you like our content, again, hit the like button. But until next time, have a happy holiday.